Hello and welcome to this fifth day of the practice to pass session on paper F6 taxation Pakistan variant. Um, we have had good 5 days, and in the previous 5 days, the things that we have discussed. What I'm actually going to do is that I'm going to have a quick review of the things that we have discussed in the previous 5 days. So up till now, what have we done? We have actually gone through the income from business. We have gone through the income from property. We have also gone through the income from salary and the capital gains. This is what we have done up till now. So we are now going to move forward and we are now going to start discussing about another aspect. And the next thing that we are going to discuss is basically the tax credits and reductions. That is what we are going to actually discuss in today's session. Now, before I go on discussing the tax credits and reduction, I would uh, I would like to explain a few things with respect to how the tax liability is computed. And before, once you know the how the tax liability is computed, then you would be able to have a good understanding of what exactly do mean by the tax credits and all. Okay, so before we start discussing about this tax credits and tax reductions, let's try to understand one specific concept. And that one specific concept is basically that whenever we compute the tax liability, whenever we compute the taxable income. So once you have computed the taxable income of an entity, after the computation of the taxable income, what actually happens is the next step is to compute the tax liability. Once you have calculated the taxable income, the next step is to establish the tax liability. So whenever we do calculate the tax liability of a business, of an individual, or of an AOP, or of a company, or whatsoever, so basically what happens is at the time of computation of the tax liability, at the time of computation of the tax liability, you apply the various tax rates. What are the various tax rates that we apply? So it depends upon what sort of person whom we are actually calculating the tax liability for. So we accordingly apply the relevant tax rate. Like for example, the salaried individuals have got these tax rates. And then you move a bit forward, so the non-salaried individuals have a different type of tax rate. Then we have got an association of person, a different type of tax rate is applicable to the association of person. Different tax rates are applicable on the companies, etc., etc. Now, so what we do is that we compute the taxable income. Once we have computed the taxable income, we calculate the tax liability by applying an appropriate tax rate depending upon what sort of type of person you are. So appropriate tax rate is applicable and the tax liability is computed. Now, once the tax liability is computed, then what happens is there are few reductions in the tax liability. There are few reductions in the tax liability. What exactly are they? There are few reductions in tax liability. So these reductions in tax liability are there. Then what we have is basically net tax liability. And once we have that net tax liability, we say tax already paid. What do we say? We say tax already paid. So the tax already paid is deducted, and then resultingly, what happens is we say the balance tax payable. We say balance tax payable. So whenever we calculate the tax liability, this is how things are actually done. That you have a computation of taxable income. Once the taxable income is computed, then you establish a tax liability on the basis of that. And then there is a reductions in the tax liability, so you end up getting the net tax liability. Once we have the net tax liability, so we deduct the tax already paid out of them. So we end up getting the balance tax payable. We end up getting the balance tax payable. That's how we actually do. Now let's move forward and let's just start discussing these things. So basically, what are these reductions? How do we compute? How do we establish these reductions? This is all we are going to consider in this specific section, which is the tax credits and reductions. So the income tax credits and rebates, let's actually start discussing how do we establish the tax credits and the rebates. So I've actually discussed this thing, that what are the tax credits and the rebate, how do we establish it. If you could see, you would find out this thing, the computation of the tax liability is tax liability as per the slab of the tax rates. Then what you do is that you deduct the full-time teacher and researcher allowance. What exactly is it? I'm going to explain this full-time teacher and researcher allowance. Then the next situation is you have a foreign tax credit. What exactly is this? I'm going to explain this also. Then there are other tax credits which include the charitable donations, etc., etc., and there's a long list. So I'm going to discuss each and every of the item, and so that we can have a good idea about how the tax liability is computed, what sort of tax credits are incorporated, so we can have a good idea from this specific computations. Now let's try to understand, let's try to see how things go. The first thing that I've mentioned here is basically in the computation of the tax liability, there is a full-time teacher and researcher allowance. Now, what exactly do you mean by this full-time teacher and researcher allowance? Let's just start discussing. Let's actually talk about it. When we talk about this full-time teacher researcher allowance, there is actually whatever the relevant provision is mentioned here with respect to the full-time teacher researcher. But what I'm actually going to do is that I'm going to discuss it first, and then I'm going to go through this specific provision of the law. Now, what exactly is it? Let's try to understand. Basically, what happens is, since teaching is one of the noble profession, and the government actually wants to encourage the teaching profession. So in order to encourage the teaching profession, what they actually do is they the government what they do is that since they want to encourage the teaching profession, they give a tax rebate to the to full-time teachers and researchers. Now, a full-time teacher and researcher, if he is actually a self-employed person, then he is not eligible to obtain this tax credit. He is only eligible to obtain this tax credit if he is employed somewhere. If he is employed somewhere. So for example, let's try to understand this thing. Assume that you have got a salary which is actually, let's say, 3 million. You have got a salary which is actually 3 million. The tax liability which turns out to be on that specific salary is, let's say, the tax liability turns out to be 70,000. So if the tax liability turns out to be 70,000, because you are a full-time teacher, so there is actually going to be a full-time tutor allowance. There's going to be a full-time tutor allowance at the rate of 40% of the tax liability. So what is actually going to happen is 28,000 is going to be the relevant tax credit, and the remaining 70,000 minus 28,000, which actually equates to 42,000, would remain as your tax liability. 42,000 would remain as your tax liability. So I'm repeating it again. What exactly do you mean by this full-time teacher researcher credit? So your tax liability is computed, and once your tax liability is computed, so basically what happens is resultingly, once your tax liability is computed, then resultingly what happens is um, you actually claim this full-time tutor and researcher allowance, and after that you are actually left with the remaining tax to be paid. Is it okay to everybody? Okay. Okay, Muhammad Amin is asking, is this 70,000 tax liability or tax deducted? No, it's a tax liability. It's a tax liability. Okay. There's another question. He says, is there any specific kind of research that has allowed this credit? Okay. Yes, there is a specific type of research. I'm just going to explain. On salary, taxes deducted at source. What about non-scientific research? Is this allowed? Okay, just wait for a second. I'm just going to explain to you. I've just mentioned that a full-time teacher or researcher allowance is there. Now let's actually try to understand that what exactly is this full-time teacher or researcher allowance. I'm going to explain to you further also. Okay, so the next situation is basically who is eligible to get this full-time teacher or researcher allowance. So you need to understand this specific thing. It says that tax payable by a full-time teacher or a researcher employed in a non-profit education or research institution duly recognized by Higher Education Commission, a board of education, or a university recognized by the Higher Education Commission, including government training and research institution, shall be reduced by an amount equal to 40% of the tax payable on his income from salary. Shall be reduced by 40% shall be reduced by an amount equal to 40% of the tax payable on his income from salary. So basically, depending upon if you are working as a full-time tutor or if you are working as a full-time researcher, with whom, with either a not-for-profit organization or a research institution which is authorized by the Higher Education Commission, which is authorized by the Board of Education, then your salary is going to be deductible. The tax on your salary is going to be deducted, reduced by 40%. Now, let's try to understand this thing. For example, if you are working as an accountant at a school, you are working as an accountant at a school. So if you're working as an accountant at a school, then what is actually going to happen is, I'm repeating it again. If you're working as an accountant at a school, then being an accountant at a school, your tax liability is not going to be reduced because you are working at a school which is authorized by the Board of Education, but you are not working as a tutor. You're not working as a researcher. You're working as an accountant, then your tax liability would not be reduced. Same goes for any other personnel. Somebody is working as a customer service representative. Somebody is working as a marketing personnel. So whatsoever is your work, basically what happens is the only thing that is actually going to lead to a situation where you would have to get a reduction, that is when you're working as either a full-time teacher or researcher. A lot of people would be wondering what sort of research institution are they. You might have heard about the word KRL, Khan Research Laboratory. You know that a lot of universities, what they have their own. A lot of universities, they have their own research departments. So even if you're working with a university in the research department, that means you're working as a full-time teacher, full-time researcher. Now, there's another concept that needs to be understood with respect to this full-time teacher or researcher tax credit, which is basically, let's try to understand that. Assume that you are somebody who has got income from other source of, let's say, 500,000. You have income from salary of, let's say, 1.5 million. And what happens is you have some business also from which you have earned, let's say, 500,000 more from the business. So in total, your total income is 2.5 million. Now, when we talk about the 2.5 million, the tax liability that your tax liability arises to, let's assume, I'm just taking an hypothetical example. I'm not performing a proper calculation. Assume that it turns out to be 60,000. Now you say that my salary, I'm actually working as a full-time teacher researcher. I'm a full-time teacher or researcher. It's just that I get income from other sources also. I get income from business, but I don't work there. I work at a full-time institution. So what is actually going to happen then? Basically, your tax liability is going to be reduction by 40% is going to apply. And if I say 24,000, then this is how we would expect the reduction to be applicable. But this is not the case. But this is actually not the case. Why this is not the case? The reason behind that is the reduction in the tax liability is only from the income from salary. It's not pertaining to the entire income. So you are a full-time teacher or researcher, then it's expected then what you would be getting is the income from. Then what you would be getting is the income from salary only. Now, if you're getting income from salary, so basically what happens is your tax reduction would also be from the income from salary. So how would we compute this tax reduction? In order to compute this tax reduction, what you would do is that you would say, I'm repeating it again. In order to compute this tax deduction, what you would do is that you would actually say that the salary income is 1.5 million. What would be the tax liability if only salary income's tax liability is computed? Assume that 1.5 million tax liability turns out to be, let's say, 25,000. So what happens is you would claim a reduction of 40% on this. So it turns out to be 10,000. So basically what is going to happen is you can only claim 10,000 deduction over here, and the rest 50,000 is going to be paid. And the rest 50,000 is going to be paid. So the rest 50,000 is going to be paid. Kindly look at this so that we can then move forward. Yeah, is it okay to everybody? Is it okay to everybody? Okay, let's start discussing further. So we have talked about one of the aspect, and that was a full-time teacher or researcher. So we have discussed that how the tax liability pertaining to a full-time teacher or researcher is computed. Now, so what happens is assume that you had a tax liability of 5 million or 500,000, and then a reduction of 200,000 took place pertaining to a full-time teacher or researcher. You are now left with 300,000. Now, what next is there? The next situation is we are also given the credit for the foreign tax. We are also given the credit for the foreign tax liability. Now, what exactly do you mean by the foreign tax liability? Let's try and understand the foreign tax liability. Now, what exactly is this foreign tax liability? Let's try and let's understand. Basically, what happens is um, I'm going to talk about the foreign source income also, but let's try to understand this thing. What can actually happen is you're resident in Pakistan, but you've got a foreign source income. You're resident in Pakistan, but you have got foreign source income. So I'm repeating it again. What happens is you are resident in Pakistan and you've got a foreign source income. When it comes to having the foreign source income, then what actually happens is you know this thing that if I am somebody who is resident in Pakistan, then this is my Pakistan source income. This is my foreign source income. So this is going to be my total income. So this is going to be the entire taxable income. And what you would actually be required to do is you would be required to pay the tax on this entire income since you are resident here. So if you are resident in Pakistan, then you have to pay tax on your Pakistan source income and on your foreign source income in Pakistan. So I'm repeating it again. If you are resident in Pakistan, you have to pay tax on your Pakistan source income and on your foreign source income in Pakistan. Now let's try to understand how things are gonna operate. Let's discuss. Basically, what happens is there is a possibility that, let's say, you had Pakistan source income of, let's say, that it was 1 million and the foreign source income was, let's say, 400,000. So resultingly this is 1.4 million that turns out to be your total taxable income. Now if the total taxable income turns out to be 1.4 million, the tax liability is basically um, is computed on this 1.4 million, and the tax liability turns out to be, let's say, it turns out to be 100,000. So you as a taxpayer may argue with the tax authorities that my foreign source income, I have already paid 20,000 in the foreign country. I've already paid 20,000 in the foreign country. So if I am paying 100,000 here also, where my foreign source income is also added to my Pakistan source income, that means that is actually double taxation upon me. That means that is actually double taxation upon me. Now, if that is double taxation upon you, so how exactly are things gonna operate? So basically what the tax authorities they do is that they allow you a reduction. They allow you a reduction in your tax liability because you have already paid tax in the foreign country. So they do understand this thing, that it is going to be very unfair with you if you are being imposed taxation twice. Like, you've already paid taxation on your foreign source income in the foreign country, and if you are going to pay taxation on your foreign source income here in Pakistan also, then that is actually going to be double taxation, and it is going to be a bit unfair with you. It is going to be a bit unfair with you. So how do tax authorities actually manage this? How do tax authorities they actually manage this? So first of all, what happens is that if what happens is there is actually a foreign tax credit that is available. Now, what is this foreign tax credit? It is subject to the double tax treaties, but the foreign tax credit is available is like this. What happens is you have to calculate the foreign tax paid. Here we have got the foreign tax paid to be 20,000. We have got the foreign tax paid, which turns out to be 20,000. And if the foreign tax paid turns out to be 20,000, then what happens is we need to see the Pakistan tax payable on foreign source income. We need to see the Pakistan tax payable on foreign source income. Now, what exactly do you mean by Pakistan tax payable on the foreign source income? How exactly do we manage this? How exactly do we calculate? Let's actually try and understand. Now, so what is this Pakistan tax payable? The Pakistan tax payable is calculated like this. First of all, you say the tax liability, which is 100,000, divided by the taxable income, which is 1.4 million, multiply by. So we had the tax liability, which is 100,000, divided by the taxable income, which is 1.4 million, multiply by the foreign source income, which is 400,000. So you multiply it with the foreign source income, which is 400,000. So resultingly, what do you get? Resultingly, what you get is basically 100,000 divided by 1.4 million. Multiply by 400,000. So resultingly, it becomes 28,571. So the foreign tax credit that is actually available is the lower of these two amounts. Is the lower of these two amounts. So resultingly, your tax liability stays at 80,000. So resultingly, your tax liability stays at 80,000. Now try to see what have I done. I simply calculated the Pakistan source income. I added the foreign source income to it. Once I've added the foreign source income to it, my total taxable income arises. What I actually did was I computed the tax liability based on the Pakistan tax rates, and then I have calculated the foreign tax credit that can be claimed. Now, what is this foreign tax credit that can be claimed? So it's actually the lower of foreign tax paid or Pakistan tax payable. So foreign tax paid is 20,000. What's the Pakistan tax payable? The Pakistan tax payable is actually going to be the tax liability divided by the taxable income. The tax liability divided by the taxable income multiplied by the foreign source income. Multiply by foreign source income. Okay, is everyone okay with it? So now let's see that when we talk about the foreign source income, we say that the tax credit relating to the foreign source income is applicable to a resident taxpayer who has paid foreign tax. Now, very important point is you should have paid foreign income tax. If you have not paid foreign income tax, you're not eligible to claim this reduction. You are allowed tax credit at the lower of foreign income tax paid or Pakistan tax payable on net foreign source income. Pakistan tax payable on net foreign source income. Now let's try to understand this. So it's a Pakistan tax payable on the net foreign source income. How do we calculate the Pakistan tax payable? So Pakistan tax payable is basically the average rate of tax. How do you compute average rate of tax? So it's basically the tax liability divided by taxable income. It's the tax liability divided by the taxable income. That's how you calculate average rate of tax. It says rule to be applied separate for each head of foreign source income. That is, if you have got foreign source income, income from business, income from other source, etc., etc., then the tax credit pertaining to the foreign source income, sure, each head shall be computed separately, because in the foreign countries there might actually be a possibility that a rate of tax applicable on the capital gain may be different. Rate of tax applicable on other sources may be different. Rate of tax applicable on business may be different. So you have to apply it to each one of them on a separate basis. Now, another important point is the tax credit cannot be carried forward. How? See, in this example, the Pakistan tax credit was 28,571, whereas foreign tax paid was 20,000. So there is actually a difference of 8,571. There's actually a difference of 8,571, and we're simply gonna ignore it. We're not gonna consider it. Why? Because it cannot be carried forward. The next situation is basically a credit shall be allowed only if foreign income tax is paid within 2 years. Now, that's a very important point, that the tax credit shall only be allowed if the foreign income tax is paid within 2 years. Like, you have claimed foreign source income, but you have not paid tax to the foreign tax authorities. If you have not paid tax to the foreign tax authorities, then what actually happens is you cannot claim that tax credit. Like, for example, this is tax year 2019. In tax year 2019, you claimed the foreign tax credit, and you did not pay tax to that foreign tax authority in 2020, you did not pay the tax in 2021. So now what is actually going to happen? What is actually going to happen is, you, if you have not paid in 21, then in 2022, whatever the foreign tax that you had paid is actually going to be reversed. Whatever the foreign tax that you had paid is actually going to be reversed. So this is what you have to do. Zishan, sales tax has not been covered, and it's unlikely going to be covered also. Um, we will stick to this tax credits and the income from other source and the foreign source income, things like that. Will not go on to the sales tax. Okay, is everyone okay with this foreign tax credit? So basically what is going to happen is, when you talk about it, resultingly this foreign tax credit is going to be calculated. Now assume that you have got a foreign tax credit of 20,000, so your tax liability now stays at 280,000. Now try to understand this thing. When we calculated the foreign tax credit, it is after the reduction. So basically, in order to calculate the average rate of tax, this 300,000 tax liability divided by whatever the taxable income, that is going to be used. 300,000 divided by taxable income, that is actually going to be used. Okay, now let's move a bit forward and let's start discussing about the other tax credit. So we have talked about the full-time teacher researcher, then foreign tax credit. Yes, Zishan Abdul Rahman, maybe in the upcoming sessions, we'll be covering the sales tax. Unfortunately, not in the current session. Let's move a bit forward. Let's start discussing. So now the other tax credits. Now, very important concept is, basically you would see one thing, which is, once we calculated the full-time teacher or researcher allowance, we deducted from this tax liability. Then the remaining tax liability is here. Then what happens is, the foreign tax credit is based on the revised tax liability. And once the foreign tax credit is deducted, you're now left with the other you're now left with the residual tax liability. Now, what is going to happen with respect to this residual tax liability? Let's try to understand this. Let's try to understand the concept. Okay, so what are these other tax credits? So there is basically specific sections starting from section number 61 till section number 65 of the income tax ordinance. Starting from section number 61 till section number 65 of the income tax ordinance, which actually covers up this thing. Section number 61 till section number 65, which covers up this thing. Now let's try to understand. Let's try to see what exactly are they. So first thing that we are going to talk about, is going to be the charitable donations. Now, what exactly are these charitable donations? What do the tax authorities do with respect to the charitable donations? Let's try to understand. Uh, First of all, the charitable donations are actually of two types. The charitable donations are actually of two types. One of them is to the organizations listed in second schedule. Organizations listed in second schedule of the income tax ordinance. And the other one of them is to the other organizations. So, since the government wants to encourage philanthropy, so in order to encourage the philanthropy, what the government has done is government gives you credit for the donations that you make to the charitable institutions, because uh, that actually uh, that actually encourages people to give more and more donations, and hence the charitable institutions, they flourish, because when the people are getting a tax benefit, it encourages more and more people to use this, because it gives them both the benefit, the effects after the life, I mean, that give you the benefit after life also, that the almighty will be happy. And the second benefit that it gives you is the taxation benefits. Now, how? So basically what happens is there is a tax credit that is allowed, and the tax credit is allowed at the average rate of tax, on the eligible amount. Now, what exactly is an eligible amount? What exactly is this average rate of tax? Let's try to understand this. Basically what happens is, once you have this tax liability, let's try to understand this. You had a tax liability of, let's say, 500,000. The researcher allowance was given of, let's say, 120,000. Then you had 380,000, and then you had a tax credit, which was basically the foreign tax credit, and the foreign tax credit was given, it was, let's say, 100,000. So now you are left with, or let's say it was not 100,000, but it was 80,000. So you're now left with a tax liability of 300,000. Assume that your taxable income was 2 million. Assume that your taxable income was 2 million. Assume that your taxable income was 2 million. Now let's try to understand, let's try to see. Basically, what is going to happen is, if their taxable income was 2 million and this is this 300,000 liability, so basically the average rate of tax is going to be calculated like this: 300,000 divided by 2 million. 300,000, which is actually your tax liability after these full-time teacher or researcher credit and after the foreign tax credit. And then you have got multiplied it with the eligible amount. Multiplied with the eligible amount. Now, what exactly do you mean by the eligible amount? Let's try to understand. Let's try to see that what do you mean by eligible amount. So the eligible amount as per the income tax ordinance is basically the lower of. The eligible amount for the charitable donation is the lower of the amount paid. For example, for example, uh, the donation that you have paid is 100,000. 30% of your taxable income. So 30% of the taxable income, let's say your taxable income is 2 million. So this actually gives you 600,000. The lower amount amongst these is basically 100,000. So 100,000 is going to be considered as an eligible amount. So you would say 100,000 is an eligible amount, and hence a tax credit would actually be claimed. Hence a tax credit would actually be claimed. How? Let's see. It's going to be 15,000. Is it okay to everybody? Okay, now let's move a bit forward. Let's just start discussing. So basically, if you want to claim the tax credit on these charitable donations, then you need to understand few things, that there are certain conditions which need to be met. Number one, the payment must be through banking channel. Now this is very important, because what happens is a lot of these charitable institutions, they don't actually declare where do they get the funds from. They don't actually declare that how much funds do they get and where do they get these funds from. So in order to ensure that the documentation is there, the government disallows any tax credit which is not, the government disallows any tax credit on the donations which has not been paid through the banking channel. So it has to be paid through banking channel. If you don't pay through the banking channel, you cannot claim it. That's number one. Now, if it would have been a business listed under second schedule, then even the cash donations are okay. But for the donations other than second schedule, this has to be through banking channel. Number one. Number two, the payment has to be made to either of. Now, either of, basically this is like, for example, we in general give a lot of donations. You go to a signal, traffic signal, you have got so many beggars there, you give money to the beggars. That's also donation. But is that donation claimable? The answer is no. That donation is not claimable. Okay, so what sort of donation is claimable? The donation which is paid to the organizations which are approved is claimable. The other donations, they're not claimable. The other donations, they're not claimable. So it's important that you pay donations to the institutions which are approved, which are registered, either an NGO or an educational board or something, which are registered. So you have to give the donation to them only. Okay, is it okay to everybody? Now, there is one more thing which I want you to understand, is basically if I would have paid donations to an institution which is registered in the second schedule, which is mentioned in the second schedule, then how are those donations would have been recognized? So basically, if you pay a donation to somebody, to an organization which is actually registered or listed under the second schedule, then such donations are deducted directly from the taxable income. Then they are deducted from the taxable income. What happens with them? They're deducted directly from the taxable income. You don't get tax credits for them. You don't have to claim tax credits. You get a direct deduction on them. Okay. Now there is one more concept, which is basically the concept of fair market value of the property transferred. At times what happens is you don't actually give cash to the charitable institution, but instead you give some donations in kind. Now, what do you mean by donations in kind? Like, maybe you don't give cash, but instead you give them some furniture, you give them some air conditioners, you give them some water cooler, or you give them some ambulances, whatsoever. So basically, at times, what happens is, I'm repeating it again. At times, what actually happens is we uh, we give the donations in kind. So if we give the donations in kind, then basically such donations, the donations that are given in kind, then such donations, uh, will also be considered, and they would be considered at their fair value. They would also be considered, and they would be considered at their fair value. Is it okay? Is it okay to everybody? Okay, now let's move a bit forward and let's try to discuss further. Now, what next is there? The next situation is basically we have discussed this specific tax credit. So, if I talk about it, so basically we have discussed that how the charitable donations is computed. Now let's understand tax credit for investment in shares and insurance. Now, one thing that I would want you people to understand is that no matter whatever the order that you claim, no matter whatever the order that you use for claiming these tax credit, the answer is going to be the same. That is, even if you use this as number one, this as number four, number one, or this as number one, or this as number one, everything is going to be the same, because in all of these, the average rate of tax is same. Average rate of tax is same. How? It's basically this tax liability divided by the taxable income. So basically, doesn't matter if you use, it actually doesn't matter. What doesn't matter if you use the whatever the sequence that you use for these deductions, only these. For the full-time teacher, researcher, and foreign tax, the sequence has to be followed. But if we talk about these, then this sequence can be changed and nothing is going to happen. This sequence can be changed and nothing is going to happen. Okay, let's move forward. The next is tax credit for investment in shares and insurance. Now, when we talk about the tax credit for investment in shares and insurance, let's just start discussing about it. That what exactly is this tax credit for investment in shares and insurance? Now, when we talk about the tax credit for investment in shares, try to understand this specific concept. The government wants to encourage investment in shares. The government wants to encourage equity investments. So if the government wants to encourage equity investment, what it does is it actually gives you rebate. The government wants to encourage it actually gives you rebate for investment in the equity shares. Remember, this rebate is only applicable. This rebate is only applicable for this rebate is only applicable for investment in listed company shares. It's not applicable for other company shares. Now, how do we get this rebate? Let's try to understand. The rebate is actually, again, the average rate of tax on the eligible amount. What is eligible amount? The cost of acquiring the shares. I'll talk about the insurance premium. Just wait for a while. I'm just talking about the. I'm just talking about this. Um, I'm just talking about the investment in shares for the time being. Then I'm going to talk about the other things. But for the time being, if we talk about the cost of acquiring the shares, or 2 million rupees or 20% of taxable income. For example, you have acquired the shares worth 2.5 million rupees. And then there is this 2 million rupees. And then you have got 20% of taxable income, which is, let's say, 2.4 million. So whatever the lower amount, this 2 million, this is going to be used for the computation of the tax credit. This is going to be used for the computation of the tax credit. Now, it says tax credit for investment in shares and insurance. Now, what insurance do we mean by this? So this actually refers to the life insurance. This actually refers to life insurance. So the government wants to encourage people to invest in their safety. So in order to encourage people to invest in their safety, the government has given this tax credit scheme for investment in the life insurance. So if you pay premium to a life insurance company, then you're also allowed to claim a deduction for the life insurance premium that you have paid. So basically what can happen is, it's either going to be, you can get the reduction for the premium that you pay in the life insurance premium. Now, as somebody who is actually, now try to understand this thing. I have invested in shares also. I have given premium to a life insurance company also. I have a life insurance policy. Now, what to do. What sort of exemption am I, what sort of tax credit am I going to claim? Should I claim the tax credit on? Should I claim the tax credit on this life insurance, or should I claim the tax credit on the investment in shares? So basically, it would depend upon wherever the eligible amount is higher. Like for example, I would have invested only 600,000 in the shares, but I have paid 1.5 million in the life insurance premium. So obviously I would take life insurance premium as the base. I would take 1.5 million as the base. So you cannot claim rebates, you cannot claim reduction for both. You can only claim reduction for either of them. You can only claim reduction for either of them. I'm repeating it again. You can only claim reduction for either of them. You cannot claim reduction for both. It has to be either of them. Okay. So there are few conditions which need to be met if you want to claim reduction in this insurance or investment in shares. So what are the conditions that need to be met? Number one, the investment should be in listed company. You must be the original allotee of the shares. That is, if you purchase the shares from the stock exchange, you're not allowed to claim the credit. It only has to be the new issuance of the share. Like for example, the shares were already issued in the market. You purchase those shares. You will not be allowed to claim tax credit on them. For you to claim the tax credit, you have to be the original allotee. You have to be the one who has purchased those shares for the very first time. Secondly, let's try to understand this concept also. That at times what happens is the privatization commission, it privatizes various companies. So if the privatization commission has privatized a company, then what actually happens is, um, if the privatization commission privatizes a company, then what actually happens with that is, um, you are actually and you buy the shares from the privatization commission. That is also going to be considered as having invested as an original allotee. So you are also allowed to claim tax credit on that investment also. Now, next situation is the shares must be held for 24 months. Now that's very important. For example, this is tax year 2019. You invested in the shares, you claim the tax credit. The tax credit was claimed, the reduction was claimed. Now in the next year, you dispose of the share. Now, if in the next year you dispose of the share, then what is actually going to happen? If you dispose of the share in the next year, then what is actually going to happen is the tax credit that you have claimed in the previous period, it needs to be reversed. The tax credit that you have claimed in the previous period, it needs to be reversed. Similarly, if we talk about the concept of life insurance, so the life insurance premium, if it is paid to a life insurance company which has been registered, which has been approved by ACCP, so you can claim the reduction on that. But if the life insurance company is not approved by ACCP, if it's not registered, then you cannot claim a reduction. Similarly, the policy should not be surrendered within 2 years. So whatever the life insurance policy that you have obtained, it should be held for more than 2 years period. Then you can claim the life insurance premium. Let's move a bit forward. Tax credit for investment in the health insurance. The same concept applies except that when we talk about the insurance, health insurance, it's actually the eligible amount is the lower of. So basically, the average rate of tax goes in the same way for every specific computation, but it's just that the eligible amount changes. So the eligible amount over here is going to be the insurance premium paid, or 150,000 only, or 5% of taxable income, whichever is lower. So the insurance premium paid, or 150,000, or 5% of taxable income, whichever is lower. So that is what it is going to be claimed. Now, there are few conditions which need to be met if you want to claim the credit for the health insurance. That is, you must be a filer, and the income that you are deriving is from salary or business. Like, for example, if you are deriving income from property, if you are deriving income from other source, then you cannot claim. Then you cannot claim the tax credit on the health insurance. Okay, is it okay to everybody? So it has to be filer. Secondly, it's not allowed to a company. If you are a company, you cannot claim this. If you are a company, you cannot claim this. Now let's move a bit forward, and let's just start discussing about the next, which is called the concept of approved pension fund. Try to understand what exactly is this approved pension fund. Now, if I talk about the approved pension fund, I'm going to explain this concept to you. That basically what happens is, not every company gives you a retirement benefit plan. Not every company gives you a retirement benefit plan. And even if they give you a retirement benefit plan, it's usually not that attractive. So the government of Pakistan through ACCP introduced a scheme of approved pension fund. Now, what are these approved pension fund? There were rules introduced by the ACCP that's called voluntary pension schemes. That's called the voluntary pension scheme rules. Now, what exactly are those voluntary pension scheme rules? Let me explain those voluntary pension scheme rules to you. Under those voluntary pension scheme rules, the FBR, they allowed various companies to register their pension plans, and the pension plans are going to operate as a mutual fund. Like, they would obtain money from the people, and they would invest those monies into the various securities and various other areas where they could get a constant and secured return, and that constant and secured return is going to be used to add to the add to the pensions that are actually going to be paid to the employees once they retire. Now, so FBR wanted to encourage people to invest into such schemes and secure their post-retirement life period. So, in order to encourage people into saving the money by investing into the voluntary pensions schemes, FBR introduced this concept of approved pension fund. Now, what is this contribution to an approved pension fund? Like, what happens is that if you are deriving income from salary or business, if you are deriving income from salary or business, I'm repeating it again. If you are deriving income from salary or business, and you are investing in a fund approved under the voluntary pension system rules, then you will be allowed a tax credit. Remember, it's not allowed to company. Remember, it's not allowed to company. It's only allowed to. It's not allowed to company. Uh, it's only allowed to an individual. It's not allowed to a company. So remember, if you are actually deriving income from business or salary, and you will be allowed a tax credit with the average rate of tax at the lower of what contribution of premium paid, or 20% of taxable income. So basically, whatever the contribution that you pay and the 20% of the taxable income, whatever amount is lower, you will actually get the credit for that. You'll actually get the credit for that. Now, there is a concept which actually need to be understood when it comes to this voluntary pension scheme. And what exactly is that concept that needs to be understood? Let's try to understand. The concept that actually needs to be understood is basically that this 20% taxable income limit can actually be relaxed, and it could be you can get an additional 2% for each year of age exceeding 40 years. Like, for example, if at the start of tax year you are at the age of 41, then what would happen is 20% plus 2%. If you are the age of 43, then it's 20% plus 6%. Why? Because 3 minus 43 minus 40 gives you 3, multiplied by 2% gives you 6%. So basically what happens is, when we talk about it, it's very important that you understand this thing, that the limit of 20% can be increased, can be enhanced, depending upon if you are of the age of more than 40 at the start of the tax year. So then you will be eligible to have more and more tax credits. Okay, so we are done with this specific tax credit also. Now let's move forward and let's start discussing about the next tax credit. Now, this is basically called a tax credit for the manufacturers. Basically, the government wants to encourage people to invest more and more in manufacturing. Now, so in order to encourage people to invest more and more in manufacturing, the FBR introduced this specific scheme that a tax credit would be given to the manufacturers. Uh, who is actually going to be the beneficiary of those tax credits? Let's try to understand that who is actually going to be the beneficiary of those tax credits. Let's try to understand. First thing is basically this tax credit is not available to an individual or AOP. That means if not available to an individual or AOP, that means it is only available to Okay, now let's talk about it. Sorry. So basically, I'm gonna repeat again that the government wants to encourage people to manufacture. Now, if it wants to encourage people to manufacture, so basically, what is gonna happen is that if you are a company and if you have set up a manufacturing facility, then you'll get tax credits for a period of 10 years. Then you'll get tax credits for a period of 10 years. Now, what are the tax credits that are actually going to be given to you for a period of tax year? Now, let's try to understand, let's try to see what are the tax credits that are actually going to be given to you. So it says that tax credit shall be allowed at 2% of the tax payable for every 50 employees registered with EOBI. Now, how is the government establishing that how much employment you are generating? So the greater the employment that you are generating, the greater the tax credits. Because what happens is if you are operating a company, you have registered, you have created employment for 500 people. If you have created employment for 500 people, so basically 500 divided by 50. 500 divided by 50 gives you 10. Multiply by 2%. You can claim a tax credit of 20% of your tax liability. How? Because you have got employees registered with EOBI. So for every 50 employees, you get a tax credit of 2%. Now, so if you want to claim this credit of manufacturer, so in order to claim this credit for manufacturer, these conditions need to be met, which is number one, you have to be a company, must have set up a new manufacturing unit. The time period of setting it up is between this and this period, and must be a new company and not formed through reconstitution of existing company. Because at times what happens is few companies what they do is that they break their segments and then segment is converted to a new company. you cannot claim exemption. It's about creating new employment. It's not about actually just benefiting by doing nothing. It's about creating new employment. So if you create new employment, how do you create new employment? You create new employment by actually setting up a new manufacturing unit. So if you have set up a new manufacturing unit, you will be eligible to claim this reduction. Otherwise, you cannot claim the reduction. I have a question from one of the students. He's asking how these credits are claimable means. Do I need to show the evidence to my employer, or this is only claimable via filing the return? No, Mohammed Amin, I am going to explain to you. Like, for example, if I am a salaried taxpayer and I'm working in an employment, so what you could do is that there is actually a form on the FBR website that comes in, and what you could do is that during the tax period, you can submit to your employer the slips of the charitable donations. You can submit to your employer the evidence of the investments that you have made in shares, the evidence of the taxes that have been deducted from your telephone bills, and etc. etc. and taxes that you have paid on the transportation. Because what happens is when you buy air tickets, at the time of buying the air tickets, you also make payment of this tax. So what actually happens is you can claim rebates during the tax year also. All that you have to do is that you just have to go take the evidence to your employer and request your employer to give you credit for all these deductions that have been made, or all these things that you have considered. Okay, then there is another which is tax credit for investment, and I have not actually mentioned the other. So tax credit for investment is basically uh, the tax credit equal to 10% of the amount so invested. Amount so invested shall be allowed against tax payable in what case? In what case where you have actually invested for the purchase of a plant and machinery for the purpose of extension, expansion, balancing, modernization, rehabilitation, which is BMR, of the plant and machinery already installed there in an industrial undertaking set up in Pakistan and owned by it. So basically, if you are a company and you have invested in plant and machinery in your country, either for the acquisition of new plant and machinery or for the rehabilitation of the existing sick units, then what happens is, what you could do is that you can get a claim. You can get a claim of 10% of the amount of investment. Like, for example, you have made 100 million investment, you can claim tax credits of 10 million because it's 10% into the amount invested. So this is how you get the various tax credit. So I'll go back to where I actually started off. Basically, if you want to know that how the tax credits are computed, let's try to actually understand this, that in order to compute the tax credits, this is what you have to actually follow, that the various rules are there. But overall, you need to understand this thing, that it's only the full-time teacher or researcher and the foreign tax credit where the tax liability changes. Then the remaining tax credits can be obtained, can be claimed in any sequence. It doesn't matter, because the average rate of tax is the same for all of them. Is it clear to everybody? Now, there are one or two more of the tax credits which I'm actually going to discuss, so that we could just finalize that whatever the tax credits are there, so we are able to finalize all of them. Okay, so I have in front of me the income tax ordinance, and under this income tax ordinance, I'm going to discuss the other aspects to you also. And that is basically, now number one aspect that I'm going to discuss is tax credit for enlistment. Now, what exactly do we mean by enlistment is basically when a company gets listed. That's called tax credit for enlistment. It says where a taxpayer, being a company, opts for enlistment in any registered stock exchange, a tax credit equal to 20% of the tax payable shall be allowed for the tax year in which said company is enlisted and for the following 3 tax years. So that's encouragement. That's encouragement. Now, what's an encouragement? That if you get listed, then the first year 20%, second year and the third year 10%, and 10% tax credit is claimable. So first year it's 20%, second year 10%, and third year also 10%. So this is how you claim the tax credits if you get enlisted on any of the stock exchanges in Pakistan. Let's move forward. Let's discuss further. The next aspect is the tax credit for a newly established industrial undertakings. Now, let's try to understand the concept of the undertaking, industrial undertaking. So it talks about that where taxpayer being a company, important thing is for the company, is formed for establishing and operating new industrial undertaking, including corporate dairy farming, sets up new industrial undertaking, including corporate dairy farm, it shall be given a tax credit equal to an amount as computed in subsection 1A. Now, what is the amount? The amount of person's credit shall be computed using this formula. What is the amount of tax assessed? B is the equity raised through issuance of new shares, and C is the total amount invested in setting up the industrial undertaking. So basically what happens is your tax liability divided by equity multiplied by investment. So for example, your tax liability is 5 million, the equity is 100 million, and the investment which is in total is 200 million. So resultingly 5 divided by 100, this is 20, and multiply by 200 million. So what happens is 400 million is, sorry, 1 upon 20 multiply by 200. So you end up getting 10 million as a tax credit. So how do you get tax credit? If you are actually investing in an industrial undertaking, so you get the tax credit like this. Okay. So basically this is what is there with respect to the tax credit. So I hope that you people understand the concept of tax credits now, that what exactly are these tax credits, how they actually reduce your tax liability, how they actually reduce your tax liability. Is everyone okay with this? Are there any questions? Are there any problems? Anything that you may want to ask? I'm actually going to take a break for 15 minutes now. Okay, so welcome back. Sorry, we had some power issues over here, which resulted in delay in the resumption of the class. Anyways, now let's actually move forward and let's just start discussing about other aspects. So up till now, we have actually started discussing about okay now. So the next situation is we are now going to move on to the next area, and that is actually the income from other source, because we had not discussed the income from other source. So we are now going to discuss the income from other source, which is basically section number 39 of the income tax ordinance. Okay, now what exactly is this income from other source? Let's just start discussing. When we talk about the other source, so income from other source is basically that income which does not fall under any head. Income from other source is an income which does not fall under any other head. Like for example, an income which does not fall in the business income, an income which does not fall under property, an income which does not fall under capital gain, an income which does not fall under the salary, then such an income is called the income from other source. So income from other source is the residual head. So any income which does not fall under any of the other heads, that is considered to be income from other source. Now, when we talk about the income from other source, so the important concept is basically that what are the definitions of the income from other, what are the examples of income from other source. Let's try to understand. So it says dividend. So whatever the dividend that you get, it's income from other source. The royalty, the profit on debt, which is also termed as interest. So the profit on debt, the additional payment on delayed refund under any tax law. Now very important point is that additional payment on delayed refund under the any tax law. For example, even in the income tax ordinance, there is actually a law that if you have filed a return, if you have claimed a refund from the tax authorities, they have to pay you the refund in an X number of time. If the tax authorities don't settle the refund in X number of time, then you are eligible to claim a penalty or additional payment or a surcharge from the tax authority on that specific refund. Now let's move forward. Then the next is basically ground rent. A very important concept to understand about ground rent. I did mention about the ground rent when I was talking about the income from property yesterday. Now to elaborate further with the ground rent, try to understand. Usually there are land which are freehold land, and if you are the holder of a freehold land and you have given somebody that land, the land becomes a leasehold land for that person. So basically, whatever the rental that is paid by a leasehold person to the freehold person, that is called a ground rent. That is called a ground rent. So the ground rent is income from other source. Rent from sublease of land or building. So if you own a property and if you lease it, then it's actually income from property. But if you don't own a property, you have actually obtained a property under a lease and you now sublease it. So basically that sublease rental is going to be considered as income from other source. Then the next is income from the lease of any building together with plant or machinery. If you would remember, I did discuss while computing. If you would remember, I did discuss while computing the um, I did discuss while computing this income from property that if you have actually leased out a property along with plant and machinery, then such a lease is not considered to be income from property. So basically what happens is if you get any rentals for the plant and machinery, those rentals are not considered to be income from property. Instead, they fall under the income from other source. Now, what next is there? It says income from provision of amenities, utilities. That's already discussed by us, that the utilities or amenities, they're all considered to be income from other source. Now, similarly, any annuity or pension. Now, what is this annuity or pension? So, if the annuity is a constant payment that you get over a period of time, and the pension, if it is not from the employment, if it is from some other source, then that is also going to be considered as income from other source. Like for example, if the government pays you pension, then that's an income from other source. Now, if you would have been a government employee, that's income from salary. If you would not, if you are not government employee but the government pays you pension because you are of a certain age, then that is actually the income from other source. That is actually income from other source. Let's move a bit forward and let's discuss further. So the next actually aspect is the prize bonds winnings from raffles, lottery, crossword puzzles, etc., etc. So any prize bond income, that's also income from other source. Also, it says amount received as consideration for the provision or use of exploitation of property, including grant of a right to explore, exploit natural resource, etc., etc. That's also income from other source. Okay, next, fair market value of any benefit, whether convertible to money or not, received in connection with provision, use, or exploitation of property. Now, let's actually talk about it. With the provision, use, or exploitation of a property. Basically, what happens is, if you get any money for, let's say, exploration of mineral resources or anything, that is all going to be considered as income from other source. Then the next is a very important point, which is basically any amount received by a person as consideration for vacating the possession of a building or part thereof, reduced by any amount paid by the person to acquire possession of such building or part thereof. Like, for example, you have a property and somebody wants you to vacate that property, and in return, she is paying you a certain amount. So, if you are actually getting the payment for the vacation of the property, then such payment is also income from other source, but it has to be taxed in 10 years. It has to be taxed in 10 years. So that is actually going to be taxed in 10 years. Now, last is any amount received by a person from approved income payment plan or approved annuity plan under voluntary pension scheme. So remember this thing, that if there is a voluntary pension scheme, remember, if there is a voluntary pension scheme, that such voluntary pension scheme is not for the income from salary, but instead that is actually income from other source. So that is actually going to be income from other source. So you get the concept of what the income from other source is all about. Now let's see, let's talk. So we are actually being told that income from other source, it says income of every kind received by a person in a tax year. Received by a person in a tax year. If it is not included in any other head, then it shall be chargeable to tax in that year under the head income from other source. So very important point is, you need to understand that income from other source is actually taxed on a cash basis or on a receipt basis. And what exactly do you mean by receipt basis? So you do know the concept of receipt when we did discuss about the income from salary, that what exactly do you mean by receipt. So what do you mean by receipt? You do know, you have a good idea that what is the receipt basis. Is it clear to everybody? Now let's try to understand one or two more aspects, which is basically, the law says if any amount received as a loan, advance, deposit, or gift by a person in a tax year from another person, not being a banking company or financial institution otherwise than by cross check, then such shall be treated as income chargeable to tax under that income from other source. So basically what happens is, if you get a cash gift, if you get a cash loan, that is all gonna be considered as income from other source. That is all gonna be considered as income from other source. So if you get a cash gift, you get a cash loan, that is all gonna be considered as income from other source. The next situation that we are gonna talk about is, it says the deductions in income chargeable under the head income from other source. Now remember one thing, that what exactly do you mean by deductions from the chargeable under the head income from other source. So let's try to understand that what are the deductions. So basically all of the expenses that are incurred in order to earn that income from other source, all of those expenses are claimable provided they are not claimed under any other head. So if an expense is not claimed under any other head, and if it is incurred in the computation, if it is in earning the income from other source, then such expense is deductible. So basically what happens is the rules which are applicable for the claim of deduction under the head income from business, that is the payment should have been made through the banking channel, etc., etc. All such rules, all such provisions are actually going to apply. So when we talk about the income from other source, this is how things are actually going to operate. So I hope this is clear to everybody, that how income from other source is computed. Is it clear to everybody? Is there any other question that you have in relation to income from other source? Okay, there is actually a question, what are the tax rates for other sources? Okay, just hold on for a second. I'm going to explain that what are the tax rate for income. So the tax rate for income from other source, just hold on for a second. I'm going to explain it. Okay, so before we talk about that, what tax rate is going to be applicable, let's try to understand this specific concept. There are actually three types of tax regimes that are applicable in Pakistan. One of them is called normal tax regime. The other one of them is termed as the final tax regime, or we also call it the final tax regime, or we also call it presumptive tax regime. Then there is this minimum tax regime, and there is another concept which is called separate tax regime. Now, let's try to have a discussion about what exactly are these various tax regimes. So I'm going to explain to you the concept of this normal, final tax, minimum tax, and then we will discuss about the tax rate applicable on the income from other source. Now, first of all, let's try to understand that what is this normal tax regime. So a normal tax regime is what we have been discussing up till now, where, like for example, when we computed the income from business, so we did talk about the concept of the profit, and then from the profit we deducted the expenses. So we deducted the expenses, and after deducting the expenses, whatever the net amount is available, we pay the tax on. So whatever the net amount is available, we paid the tax onto it. So the profit, expense, and then there is this net income. So you pay the tax on it. So this is what is considered to be a normal tax regime. So one of the aspects is the normal tax regime. Now, what is the second aspect? Let's try to understand. Basically, there is a concept of minimum tax regime. Now, what is this minimum tax regime? As we did discuss in the yesterday's session, that minimum tax regime actually means that usually what happens is, let's say you've got sales of 50 million, but the profit that you have earned is only, let's say, 1 million. So on a profit of 1 million, you'll pay tax of 30%. So that would actually include 300,000 other tax. But your revenue was quite high. So generally what happens is the government, it wants tax to be collected. So in order to ensure that the government is able to collect maximum tax, the government introduced a minimum tax regime. Now, what is this minimum tax regime? The minimum tax regime is actually the government laid down a procedure that you have to pay a certain minimum tax. Now, what is this certain minimum tax that you have to pay? So, for example, 50 million multiply by. So, for example, 50 million multiplied by 1.25% is a turnover tax that every person has to pay as a minimum. That every person has to pay as a minimum. Obviously, there are few. Obviously, there are few restrictions. There are few things that need to be followed. But 50 million. So you will end up getting what? 625,000. So basically, although you are getting 300,000, but still you will still end up paying 625,000. Why? Because under the minimum tax regime, what actually happens is you have to pay a bare minimum X amount of tax. So although the tax liability turns out to be 300,000 under the normal tax, but the minimum tax, which is 625,000, is to be paid. So you have to pay at least this 625,000. Okay. So that's another aspect, the minimum tax rate. So minimum tax regime is actually applicable to a lot of things. One of them is turnover tax. The another thing is basically when the tax is deducted upon the electricity bill. So that is another concept. So, but I'm not discussing it right now. So that's what the minimum tax regime is. Then there is this final tax regime, which I need to explain to you so that you can have a good idea. Now, try to understand this thing. For example, you made an export. You exported goods worth 100 million. And then now what happens is you claimed expenses against this export. And the expenses that you claimed were 105 million. So resultingly, you showed a 5 million loss. You showed a 5 million loss. Now let's try to understand. I'm repeating it again. What actually happens is there was an export of 100 million and the expenses that you claimed were 105 million. So resultingly, you ended up getting a 5 million loss. So now, since you have a loss, you will not be paying tax to the government. So what is the government gonna get? What is the government gonna get out of all this? So basically, the taxpayers, they used to manipulate their taxable income this way by showing excessive amount of expensive. So what the government had to do was government had to find some way. Either they go on performing lengthy audits of the taxpayer, or the alternate option that the government had was they introduced this concept of FTR, which is final tax regime. Now, what was this final tax regime? They identified several specific sectors, several specific heads, like say income from interest, or the import, or basically the exports, or basically the dividends, or the supplies, etc., etc. They identified several heads. And what they actually did was they specifically mentioned that um, no matter what you earn, no matter what your profit is going to be, we are going to charge you an X amount of tax on this specific income. So basically, if you do an export, no matter what you earn, you have to pay 1% of the export value as a tax to us. And you're not allowed to claim any expenses. Even if you are running into loss, pay us 1% of the sale. Pay us 1% of the export. Even if you are running into loss, pay us 1% of the export. So that is what the government did. Okay, so basically this final tax regime is another way, or the presumptive tax regime, where the government says that we have presumed that whatever your tax liability is going to be, this is what we have presumed. And lastly, there is this separate tax regime. What exactly do you mean by the separate tax regime? Separate tax regime generally refers to those items which are not included in your total income. They're treated as separate income. They're treated separately. So that's called separate tax regime, but that is of not much significance right now. What is of more significant is to understand the difference between normal, the final tax, and the minimum tax regime. Now, so basically, the question that actually was asked was, how do we tax the income from other source? How do we tax income from other source? So it depends upon if your income from other source falls under the final tax regime, or your income from other source falls under the normal tax regime. It is actually dependent upon that where does it fall, then how the taxation is actually applied on it. Now, so basically, in order to understand that what exactly the normal tax regime and what exactly falls under the final tax regime, I would try to explain to you the concept of this, that how do we establish that what is going to be the applicable tax rate. So let's try to understand. Okay, so what I have done is I have opened the first schedule of the income tax ordinance, because the first schedule of the income tax ordinance actually covers up the tax rates. So let's actually start discussing that what are the tax rates that are covered up. Let's actually see here. First of all, when it comes to the first schedule, there are various tax rates that are available. Let's try to see that what are the various tax rates that are available. So if I talk about the first schedule, the part one is the rate of tax for individuals and AOP that is mentioned. Okay. The next part is basically the rate of tax for AOP. So AOP, there's a separate column. The rate of tax for companies is also mentioned. Then you've got um, the rate of super tax. The concept is no more there now. Then the rate of dividend tax. Now let's see. It says the rate of tax imposed under Section 5 on dividend received from a company shall be 7.5% in case of dividend received declared by WAPDA or any other power company, 15% in case of other, and 12.5% if the amount of dividend is 2.5 million, and 10% of the amount if the dividend is less than or equal to 2.5 million. So basically, these are the various dividend rates. So the dividend is subject to separate of the final tax regime. Also, the rate of profit on debt. So profit on debt is, let's say, if you get loan from a governmental institute, from a banking institution, the bank, while paying the interest to you, is going to deduct a certain tax. So the tax that they are going to deduct is going to be based on this specific item, the rate which is based on certain slabs. So this is presumptive tax regime. Now, also let's try to understand. Uh, for example, this shipping, air transport income, then Now see payment of goods. It says the rate of tax to be deducted from payment referred to and so and so. In the case of sales of rice or cotton seeds, 1.5 of the gross amount payable. In case of supplied made by distributor of fast moving goods. In case of company, 2%. In any other case, 2.5%. In case of sale of goods. In case of company, 4%. Filer, 8% for non-filer. Any other case, 4.5% of gross amount if filer, 9% if non-filer, etc., etc. So there are specific tax rates that are mentioned. So basically, all of this falls under the presumptive or the final tax regime. Okay, Imad Ahmed is asking that how do we find the tax rate for a particular sector? So I'm going to tell you that in order to find a tax rate for particular sector, because usually since you are not in a regular routine, so it becomes very difficult for people like you to have an understanding of the income tax ordinance. A better approach is going to be that you go to the website of any of the consulting firm, and when you go to the website of any of the consulting firms, so what you could do is that you could download the tax rate cards from there and you could accordingly go about it. So you have to download the tax rates cards from there and you can be in a better position to see that what tax rate to be applicable. Okay. Muhammad Amin is asking when an individual providing accounting service, auditing service falls under section 153B. Yes, he falls under section 153B. So it says in case of rendering of services, uh, in any other case, 10% of gross amount payable if it's filer and 17.5% if non-filer. And also remember that the deduction for a service provider is minimum. Like it cannot be a final tax regime. It has to be a minimum tax regime. It's the minimum tax that you have to pay. So when it comes to service provider, the rules are a bit different. But anyways, hope you people got this idea. So now it's you get the understanding of the tax regimes, that when is the final tax regime, what is the normal tax regime, and what is the minimum tax regime. Mohammed Amin, what is the case? I don't get your point. What are you asking? Case? Okay. Mohammed Amin is asking that what is the case for accounting service being taxed under section 153? Well, let's try to understand this thing. That the accounting service is actually a service which you are providing. So the audit firm or the accountancy firm, whatever services that they provide, they are considered to be a service provider. And when they are considered to be a service provider, so a service provider is taxed under section 153 subsection B. 153 subsection B. Anil is asking for the example of separate tax regime. So, okay, I'm going to give you an example of separate tax regime. Just wait for a while. I'll just help you understand the concept of separate tax regime. Okay, so I would like to help you that the separate tax regime, what happens is the separate tax regime actually means that those income which are not included in the normal tax, those income which are not included in the taxable income. So what are those income? So there are a few examples, and the few examples are basically section number 5, which is about the tax on dividend. So the dividend is considered to be a separate income. Now, when we talk about the dividend to be considered as a separate income, for example, if you are getting dividend, it's not included in your total income, it's presented separately. It's presented separately as a separate block of income. It's not included in your income from other source. There are few dividends, like for example, there are few dividends um, which are received from, let's say, the private company, etc., they would fall under income from other source. But generally, the public company dividend on which the tax is deducted, that falls under final tax regime and is not included in your total taxable income. There's another question which is, give an example for an individual, please. So providing service does not come under SRB. Okay, yes, the service is under SRB also, but the SRB is sales tax on services. Now, don't mix up this concept. There are two things. One of them is the income tax, and the other one of them is the sales tax. What we are studying right now is income tax. It's a tax imposed on income. When the tax is imposed on income, it is payable by the person who is earning the income. Like, for example, you are an accountancy firm and you are providing services, so you are earning income. If the tax is imposed on your income, you are paying tax. But there is a sales tax. Sales tax is an indirect tax. If you are providing services and your services are subject to sales tax, it's not you who is paying sales tax. It's actually the ultimate consumer of the services who's going to pay tax. Like, for example, I'm an accountancy firm. I'm rendering accountancy services to a company, and the law, which is the SRB, the Sindh Revenue Board, it tells me that you have to charge sales tax on the services that you provide. So if I charge sales tax on the services that I provide, all that I do is that I simply act as a collecting agent. I charge sales tax to my client pays sales tax to me, I pick up that sales tax and I deposit it to the government. So the sales tax on services is different, and the income tax on your income is different. The ultimate impact of income tax is upon you. The ultimate impact of sales tax is upon the consumer. Hope that clears the question for the SRB. Now, there's another person who's asking, as I asked earlier, environmental is of employees holding a position getting fixed a certain remuneration, but contract signed as individual consultant service provider, but maybe tax is deducted under section 150C. Okay, Muhammad Amin, now you see, there are two specific things which you can do. I did mention to you earlier also yesterday that look at the definition of employment. So if you are getting a fixed or ascertainable remuneration, so I did tell you that what the companies they used to do was they used to manipulate with the taxation authorities. Now, how did they used to manipulate was they used to actually tell the tax authorities that we have hired this person as a consultant, and they used to deduct the tax under section 153 on the payment of that consultant. But later on, what actually happened was, but later on, what actually happened was there was a there was a it was being challenged in the High Court, and there was a High Court decision which confirmed that. There was a High Court decision which actually confirmed that if, so I'm repeating it again, there was a High Court decision which actually confirmed that if this employee, no matter you classify them as service provider, but they are still gonna be considered as employee, and the tax rate applicable to them is going to be the tax rate which is applicable on the salaried person. Now, one more thing which you actually need to understand, and that is basically when we talk about the legal status. So as per the legal status, you may not be a salaried person, you may be a contractor. So like uh, for example, if the income tax authorities are charging you tax by treating you salaried, so salary person is in employment, and employment is not service, employment is not business, therefore the SRB is not going to be applicable on you. Now there is another question that how can I search the verdict of the High Court? Well, if you want to search the verdict of the High Court, I don't think that it's going to be available easily on the website on Google. But all that you could do is that you could refer to the publications of the taxation which are available in the market, and you can get an idea that what is it. Okay, so we are actually done with income from other source. Now let's talk about the next aspect, which is basically the agricultural income. A very important aspect, that what do we mean by agricultural income? Let's try and understand the agricultural income. When we talk about the concept of agricultural income, everyone of us know that agricultural income is exempt from tax. Everyone of knows that agricultural income is exempt from tax. Now, but there are two things that you need to understand. That one of them is the tax imposed by the FBR, and the other one of them is the tax imposed by the provincial government. So remember that provincial government can impose tax on agriculture income, because this is as per the Constitution of Pakistan, as per the NFC award, or as per the 18th amendment. This is what the provincial government can do, but FBR cannot impose tax on the agricultural income. The agricultural income is exempt from tax as per the income tax ordinance. Now, a very important point is, what exactly do we mean by agricultural income? So agriculture income, a very important concept. Try to understand the definition of agriculture income. It says agricultural income means any rent revenue derived from by a person from land which is situated in Pakistan and is used for agricultural purposes. So very important point is, what do we mean by any rent? Even if you are given somebody a land on rent, which is usually in the local language, the word mukata is used. The word mukata. Now, what is this mukata? Mukata is renting out of the land. That's called mukata. So, what happens is, any rent or revenue derived by a person from land which is situated in Pakistan and is used for agricultural purposes. So, if you cultivate your own crops and you sell those crops, then that's exempt income, that's agricultural income, and that's exempt. If you give away your land on mukata, that's also the income, rental income is also exempt from tax. That's called agriculture income, and that's not called income from property. Also, it says any income derived by a person from land situated in Pakistan from agriculture, the performance by a cultivator or receiver of rent in kind, or any process ordinarily employed by such person to render the procedure raise so and so, so and so, the sale by a cultivator, receiver, etc., etc., of the rent in kind. So basically simple, that is all going to be considered as the agriculture income. Furthermore, a very important concept, any income derived by a person from any building owned and occupied by the receiver of the rent or revenue of any land described in so and so, so and so, any building occupied by the cultivator or receiver of the rent in kind, in respect of which any operation is specified in subclause so and so is carried on, but only where the building is in the immediate vicinity of the land and building which the receiver of the rent, etc., uses in connection with the land requires as dwelling house, storehouse, or other building. Now, very important, try to understand. If I could simplify that, what do we mean by the income from agriculture? The agriculture income is basically one received by the cultivator, one received by the cultivator, one received by renting out, one received by renting out agricultural land or by renting out the building in the vicinity of agricultural land used as storehouse. Like for example, I have land on which I have constructed a very big warehouse. Now the warehouse is a building. So if I lease out building, that building is going to be considered as income from property. But there is an exception here. The definition of the agricultural income actually covers up a building which is in the immediate vicinity of the land where the agriculture is taken, agricultural business is conducted. So basically, if you have got a building which is in the immediate vicinity of the land on which the agriculture is being conducted, then such then the rental from such building is also going to be considered as exempt from tax. Then the rental from such building is also going to be considered as exempt from tax, and that is also going to be classified as agricultural income. Now let's move forward. There is another concept which I actually want to explain to you people, and that is actually a concept of, let's say that you grow rice. Whatever rice that you are gonna sell, the sale are going to be exempt because that is going to be considered as agricultural income. Assume that you have got rice processing plant also. Now, whatever the rice processing plant is, the proceeds from the processed rice is going to be taxable as income from business. The proceeds from processed rice is going to be considered as taxable income. I'm repeating it again. Okay, I'm repeating it again. So if you sell rice, that is exempt, unprocessed rice. But if you have a rice husking plant where you are refining the rice, then those refined or the processed rice is not going to be exempt, it's going to be taxable. But what happens is you are allowed to claim deduction at fair market value of rice used as raw material. So if you are using the unprocessed rice as a raw material for the processing plant, the cost of that, the fair market value of that unprocessed rice will be allowed as deduction. The fair market value of that unprocessed rice will be allowed as deduction. Okay, is that okay? Now, so we have discussed about the exemptions for the agricultural income also. Now, Okay, is everyone okay till here? Okay. So now what I would actually want you people to do now is that uh, I would actually want you people to ask any questions that you may have so that we can have a discussion relating to those questions. If there are any questions that you may have, please do ask so that I can explain to you because apparently, I mean, those things which I had to cover, I've covered them up. If there are any questions that you have to ask, do ask, please, so that the other can also benefit. Okay. Imad Ahmed is asking, what is the provincial tax? See, I'm going to explain to you this specific concept that what is this provincial tax? There are basically, first of all, try to understand there is an income tax and there is a sales tax. For example, I'm providing services. The income that I'm earning, if it is subject to tax, then the tax is going to be borne by myself. But if the services which I'm providing, if they are subject to sales tax, so I am actually going to include in my invoice, and ultimately the consumer is going to bear that sales tax. So remember, the income tax is called direct tax and the sales tax is termed as indirect tax. The income tax is termed as direct tax and the sales tax is termed as indirect tax. Now let's try to understand few more things. Now what are those few more things? Let's try to understand. One of those things is basically the sales tax can be imposed on goods. The sales tax can be imposed on services. So basically, when we talk about imposing the sales tax on goods, this is the domain of FBR, Federal Board of Revenue. And when we talk about the sales tax on services, this is the domain of Provincial Sales Tax Authority. Provincial Sales Tax Authority. Like we have got three Provincial Sales Tax Authority. One of them is called PRA, Punjab Revenue Authority. One of them is SRB, Sindh Revenue Board. And the other one of them is KPKRA, the KPK Revenue Authority. Now, what is service, what is goods? So in order to understand, I'm going to help you identify this. If you could identify this website, which is sindhrevenueboard.gov.pk. If I say Sindh Revenue Board, so this is SRB. So if you look at this SRB website, you could go into the service categories here. There's a long list of service. Unfortunately, I'm not able to open this acts and rules. Otherwise, I would have opened it up and I would have demonstrated to you that what are the services. In fact, I've got it now. So don't worry, just wait for a while and I'm going to explain to you. Here it is. In fact, no, I'm not able to access this the Sales Tax and Services Act. So if I would have been able to access it, I would have explained it to you that what are the services that are covered. But you can actually look at this Sales Tax and Services Act and you'll get an idea that what are the services. Sales Tax and Services Rules. Where is the act? Maybe the schedule 1 would cover the services. Yeah, here. So there is a huge list of services which are covered under the provincial. So like all of these people, the sales tax is going to be imposed by Sindh Revenue Board and not the FBR. So like you get the internet bill also, you get the insurance premium also, whatsoever. The sales tax on them is actually imposed by the Sindh Revenue Board. Medical practitioners, legal practitioners, accountants, management consultants, etc., etc. The sales tax is imposed by Sindh Revenue Board. Hope that clears the question now. Mohammed Amin is asking a question. Okay, Mohammed Amin, your question that if the minimum tax regime, the tax liability turns out to be 650,000 and the tax liability under normal tax regime is, uh, in fact, you see, just understand one concept. Whatever is higher, you have to pay that. You have to pay whatever is higher. You have to pay the higher amount of tax. Okay, now that's great. Anyone else has any other question, please? Okay, so that marks the conclusion of our session. Thank you very much, everyone, for attending the session. Thank you very much for taking out time and attending the session. I hope that the session was okay. One more question, Anil. Yes, go ahead, please. Yes, Anil, go ahead, please. Okay. Anil is asking a question relating to the housewives who actually have some sort of income. So I'm going to explain to you. There is a section 114. There's section 114 of the income tax ordinance that actually gives a list of people who are required to file return of income. So like you see, every following are the people who have to file return of income, which is basically every company, every person whose taxable income exceeds maximum amount that is not chargeable, which is in short means every person who has taxable income. So if there is any taxable income, you have to file. Any not-for-profit organization, uh, furthermore, any person who has been charged to tax in the last 2 years, anyone who wants to claim a loss, person who owns an immovable property of 250 square yards, who owns a land area of 500 square yards, who owns a motor vehicle, has obtained NDN, has a commercial or industrial connection, is a resident person registered with any chamber. So if you are registered with any chamber of commerce, any other body, you have to file, like you are registered with Pakistan Engineering Council, or you are registered with Pakistan Medical and Dental Corporation, etc. So all of these people have to file the return of income. So on the basis of this, if there is a housewife who has some income, she has to file the return of income. If she would have not been earning any income, then, because usually what happens is the male spouse, what they do is that they generally put investments on behalf of their female housewives. So if they are a female housewife, if she has any income, whether it's her husband's money or what, she has to file the return because she is earning income. Okay, Mohammed Amin had a question. My question regarding my tax, which is being deducted under Section 53, while I fall under employment so far as per law, should it be taxed under salary? Yes, it should be taxed under salary. I mean, um, I think your employer hasn't actually got it right if he is actually deducting under the income from this, if he's treating you as a service provider. Imad Ahmed is asking, is providing tuition exempt? Well, no. Though you may claim that you are doing a very um, a productive task, or you are actually helping the generations of Pakistan, but end of the day you are earning the income, so it's not taxable. It's taxable, it's not exempt. You're welcome, Anil. You're welcome, Imad. Okay, now a lot of you people have been attending this session for the purposes of CPD. So let me explain to you that Muhammad Amin, not for the time being, but yes, in future, inshallah, yes. Um, like one thing that I would actually want to explain to you is let's try to understand something. That basically what happens is when we talk about this income tax, a lot of you people were attending the session for the purposes of CPD. Uh, in your practical life, the most important aspect is basically the withholding tax regime, because generally speaking, day on day out, you are dealing with the withholding tax concept. Because if you are dealing with any of the supplier, any of the service provider, any of the consultant, you're purchasing goods, you are having a transportation facility available, etc., a lot of things you usually come across this issue of withholding tax. So basically what if you want to actually be updated, if you want to know, so the important aspect is that you, as somebody who's working with a company, as somebody who's working in a finance department, you should actually know that what are the tax deductions that we have to make. You should actually look regularly on the changes in the withholding tax regime which arises, because your major thing is withholding tax. And secondly, for with respect to the salary, so now you have an idea, a good idea, that what are the tax credits that you can claim and how you can claim. So you could just submit these things to your employer, and the employer is going to help you in claiming those tax credits and all that. Okay, anyone else has any other question, please? Okay, so we would appreciate if you could give feedback of the overall the session that has been conducted, because that's going to be helpful for us. And if there are any shortcomings that you find out of these sessions and anything extra that you want us to cover up in the future sessions, so we would be very like the way you want these sessions to be delivered and things like that. So if you could give just feedback on this, so it would be very helpful if you could give the feedback here only. Mohammad Amin, thank you very much for your comment. Anil, thank you. Highly appreciated the comments that you have given. Okay. Imad Ahmed, the handouts that I have used have already been sent across to you over the email. You can also download it from the handout section, and they will be sent out into the email also. Okay, Mohammad Amin, I'll give the presentation on which I worked. I'll share them with the ACCA team so that they can actually give it to you people. I'll give it to the ACCA team so that they can share it with you. Anil, your suggestion noted that the session to be reduced to 2 hours. We can increase the days. Well, I think if we increase the days, then also the attendance goes down, because what happens is generally having 5 consecutive days is too much for people to take out time continuously at this point of time. But yes, we can reduce the session to 2 hours to make them more productive. Mohammad Amin, thank you very much for your comment and thank you very much for your appreciation. Thank you very much, everybody. Thank you for your time. Thank you for your suggestions, and thank you for attending the session. We would inshallah be conducting similar type of sessions in future also, hopefully for the benefit of all. So thank you very much from myself, from the ACCA Pakistan, to everybody who attended the session. Thank you. Okay. Thank you very much.